Good morning, this is Howie, and I'm here to help you win with money. Today is Tuesday, December 8th, 2020. And today's topic, I'm going to cover something called cash value whole life or cash value life insurance. In this episode, we're not going to compare it against everything else. I have a much longer video, maybe 40 or 50 minutes long to cover that. But today I just want to address one component of this cash value concept using whole life insurance. So here I went to Dave Ramsey's website and I looked it up. What is a cash value life insurance? You see, this is a fairly new article from April 2020. He goes on and he talks about it, and it says, what is cash value life insurance? Some of us may never heard of it, so we'll just read it. Cash value life insurance is a type of life insurance policy that plays for your whole life and comes with a savings account to it. So you're paying for life insurance and you're paying for cash value. So that's what he says. But before we go on, let's try to Google this and see what we find. And I Googled it. And there's actually not a lot to be said using this actual term, cash value life insurance. Most people will still call it the traditional name, which is whole life insurance. But Google does have it, and you're able to find it here in Investopedia. And so let's just take a quick look at it. Look, it's a form of permanent life insurance, which is what we call whole life. There's a cash value saving component. Okay, and it goes into the details. It says, yes, it's more expensive. It gives you a value, does not expire, you can borrow against it, and explains how it works. Okay, so now that we know this concept exists, I want to address what we read in the Dave Ramsey article. The first thing I want to start off with is here. You're paying for two things, life insurance and the cash value. And it talks about, well, because of that, you're paying more for this. And we'll go here and you'll see what I mean. And you'll see this. You can read this or you can pause it whenever you want. I'm going to scroll down here. Insurance companies say cash value is a positive thing, blah, blah, blah. Spoiler. And look what he says. Most of the time you don't use a cash value while you're alive. It goes back to the insurance company when you die. Here's one thing. If you try to get your hands on some cash after a year, because how much you have, a big zero. So this point is saying it takes time for cash value policies to build up, and this is why he's saying it's a bad thing. So before we go on, let's scroll down a little bit. Then he talks about the types of. Okay, so let's start here. Whole life. This is what. Let's talk about this real quick. What is a whole life insurance policy? It's exactly what you think it means. When you buy an insurance policy for a whole life, the event of death is a 1 or 100%. It's absolute in terms of percentages. So when you're buying this policy, you know you're going to use it. When you're buying an auto accident policy, you may or may not be in an accident in any given year, or you may never be in an accident for the 20 or 30 or 40 years you're driving, but yet you still pay for the auto insurance. Think of term insurance as the temporary insurance. You're buying insurance policy that the event of occurrence is so small, it's less than 10% for the average person. If you're buying insurance that you have a less than a 10% chance of using, term insurance will be cheaper, because mathematically, 10 people who are buying insurance, only one person will die. I can pull the money and pay that one person's claim. In whole life, every person who buys a policy, there's a 100% of event occurring. And so therefore, you need to make sure you can fund the claims. That's just common sense. So if that's the case, wouldn't the theory then suggest that whole life should cost a bit more? Because in term insurance, the chances of dying are so slim, especially if you're in your 20s and 30s. It's actually much less than, I don't know exactly what it was, but I think it was like less than 5% chance of you dying. So for every 20 people, you can pay the one claim because you collected enough premium from the other 19. As you get older, let's say to your 40s and 50s, your chances are somewhere around 8 or 9%. And so, again, out of 11 people, one person files a claim because they died. You collected enough premium to pay that other person. But if you bought term insurance in your 80s or 60s or 70 years old, you can see why it's very expensive at that point because the certainty of death moves up. If you're in your 60s, and I don't know what the numbers are, but it's almost like 20% chance of death. In your 70s is higher, than in your 80s is probably closer to like 80% chance, right? Because as you get older and older to age 100, the chances of death are just closer to 100%. But let's address this whole concept of there's two components. I actually think that is still wrong. The way they explain this is so dumb. You are not buying two components. You're not buying a life insurance part, and you're not buying a cash component part. So let me explain that again. When you're buying a whole life insurance policy, it is for the whole life. The insurance part by itself is already more expensive because and I already explained this, the chances of that event occurring is 100%. Now, in theory, it's a little bit less because there is some people with lapse of policy and other things like that. And so, but the point here is, if the event of death is 100% in a whole life policy, wouldn't you have to collect enough premiums to make sure your company is still making money and pay out the claims? So in term insurance, of course they can charge less because the claims are a lot less. You're only buying something temporarily to cover you for short term. Let's move on to the next part. How do you access cash? They talk about how long you have to wait. And this is somewhat true. If you're buying a traditional whole life policy, the cash value piece takes really long to build up. For those who know, there are other ways to structure a life insurance policy where it builds up literally on year one, and in less than 3 or 4 years, the amount of your cash value is actually more than the amount you put in premiums. So this is a somewhat half-truth. I'm not saying it's completely wrong. It's a half-truth depending on how you structure the policy. Now let's read this. You can take out a loan against the cash value. If you take out a loan, it is the worst thing you can do. Why? First up, you're going in debt. It's never a good idea. Second, you have to pay interest on a loan. And if you don't pay back, your death benefit will decrease. Think of how crazy this is. You're paying interest on a loan made up of your own money. So let me explain why this is a bad argument. If you buy a house and you have equity in your house and you take out a loan against your house, isn't that the same thing? Does Dave Ramsey, so he should argue over all the millions of people who take out HELOCs because you're paying interest on home equity that's yours to begin with. So that's dumb too. So, but that's a standard practice. So they're both dumb if you look at it that way. But the second thing that I want to address is this concept of if you don't pay back, your death benefit will decrease. Well, this is what I want to address in this video. There's this mistake of saying there's two components to life insurance. There's only one component. It's the death benefit. If I buy $1 million death benefit, the cash value is not a separate benefit. What happened is the cash value is sort of like how much are you entitled to if you don't want to wait till you die to access the $1 million. No different from your home equity line of credit with your house. If your house has zero equity, you can't borrow money from a house with zero value or zero value that you have or that's yours. So as your house gains value, as you're paying down the mortgage, there's value that's entitled to you. You can borrow money out of that house to do whatever you want. In the same way, life insurance is the same thing. The cash value portion will grow over time. And if you have a whole life insurance policy, you will see that the cash value generally ends up at the end, it matches the death value. So it doesn't magically say, well, if you bought $1 million policy, a death benefit, and then let's say you're 80 years old and your cash value is 800,000, you're not entitled to the $1 million death benefit plus the 800,000 cash value benefit. Otherwise, you just made money out of nowhere. You magically just increased it because you didn't pay $1.8 million in premium. In fact, you still pay less than $1 million in premium. And so this concept is very misleading. And I'll address it again because I know you're going to not understand this. But let's go down in this article a little bit more. So let's read this part. What happens to the cash value when you die? By now, you know you got the hint. Cash value insurance is a total waste of money. But if you haven't even heard the worst part, when you die, the only payment your family get is the death amount benefit. Any cash value you built up will go back to the insurance company. Let that sink in. You faithfully invested in your whole life only to leave all that money to the insurance company. Doesn't sound right. Okay, so this is where I want to address this again. It is misleading to say there's two components and that two components are two separate things. They're not. When you buy $1 million policy, I don't care what type of policy, term or whole life or whatever you want to call it, you only get $1 million when you die. Okay? I want to make that clear. Term insurance is that way. Whole life is that way. The cash value is always represented in a percentage or a dollar value so you can understand it better, but it's always between 0% and 100%. So that means they're going to give you access to your death benefit while you are alive. It is not a separate investment. And so this is where I believe a lot of so-called experts like to trick you to assume that it is two different things. Like it's a 401k plan built into it. It is not. You're not buying insurance to invest. You're buying it because you want the $1 million death benefit. The difference is in whole life insurance, you have access to the part that is accumulated that you can tap into early if you choose to. So this is a concept where if you died at age 99 and you have a whole life policy, the cash value is going to be so close to the $1 million in the example I use, because most insurance policies use 100 or 120 years old. And so as you get older, your cash value gets so close to the death benefit. And when again, if you're using age 100 for some of these whole life policy, at age 100, your policy it matures in theory. And so your cash value becomes $1 million. And so if you have one of these policies that expired at 100 and you live to 104, they'll give you the $1 million. That's just how it works. But there's no 2 million at the end of the rainbow. You don't get $1 million in cash value and $1 million in death benefit. When you purchase that policy, whether you're 22 or 42, you bought $1 million policy. Experts are wrong when they try to explain this in two separate components. That is not accurate. You're buying insurance and you're paying more because the policy predicts that you will die. It's 100% certainty, and that's why it costs more than term. We covered that 5 minutes ago. So this is wrong. He is not right. So let's read this part. What's the difference between cash value and term? This one doesn't have any magic beans. He's 30 years old, don't smoke, pretty healthy, wants life insurance. Okay, look what he says. He heard that a term insurance is different because it only lasts a certain amount of time. So this is what he recommends. He buys the insurance policy with no cash value, so it makes it cheaper. So here again is a very misleading thing. It's not the cash value that makes it cheaper. The odds of a 30-year-old man dying, if he's buying a 20-year policy, that means from age 30 to 50, it's less than 5%. or whatever the number is. It could be 6%, it could be 7. My point is, it's not an 80% chance of the event occurring. So therefore, if it's only 8%, the policy can be 10 times cheaper. Because if you multiply, how many people do you need in the insurance pool to cover the one death that will happen? So you need 10 people to buy term. Only one person will die. The 10 people who paid into it will cover that one claim. So again, it's not a matter of this cash value that makes it cheaper. It is the effect of how term insurance works. You pool everybody's money together to cover the number of people, statistical chance of that event occurring will happen. And this is why everyone doesn't understand basic math, including the experts. They like to frame it and coin it their way to pitch whatever agenda they want to pitch. But on this channel, I love talking about the math. Let's explain it out. Sure, could you buy term insurance and invest the difference? Absolutely. So no one is saying you can't do it. But if everybody was doing that, wouldn't you think 40% of Americans should be millionaires by now or higher? But we know that's not true. How many people buy term and never get rich? And this is the problem I have with the data. If there's such a small percentage of people that are rich doing this, then where are all the people who are buying term and investing the difference who are millionaires? And I'm not saying whole life will do the same, right? So in theory, whole life, you can buy your net worth. And that's the concept they use. Will everyone be able to buy their net worth? The answer is no. Because if you can't afford it, right? If it was so easy to buy your net worth, everybody can say, I want to be worth $10 million. Well, how much is a policy? Well, the policy is $15,000 a year. Most people cannot afford that. So that makes sense. But you shouldn't be buying an insurance policy that you can't afford. In fact, right, you got to pad it in to make sure that you can afford it even in the worst of times. No different from how a real estate investor factors in a rental property. You don't assume you're renting your property 100% of the time. There's going to be months where that unit is empty. You need cash flow to cover it. Whole life is the same concept. So again, nothing magical there, just common sense logic that will dictate whether or not you are buying too much policy. Because if you let the policy lapse, you do come out a loser because now you bought something that you couldn't afford. There are ways to convert the policy into something else so that you don't lose all your money. But again, the point is, if you bought something that you couldn't afford, you can't magically buy your net worth. Insurance is not designed to make you an instant millionaire. It is not a lottery ticket. Insurance is exactly the way we always call it. It's a transfer of risk. If something should happen, it provides income or this giant lump sum to pay for what we think the value of your life is. That's all it is. And so I want to conclude by saying I don't agree with all these statements. You see this? This is how insurance companies make their money. That's why they're so quick to sell you cash value life insurance. That is bogus. That is hogwash. It's all mathematics. If you buy term insurance and if you don't use it and only 10 people die or 10% of people die, then you can figure out how much money you need to charge everybody in the pool. No different from other type of insurance. And let me try to explain something. I'll give you a freebie. There's very little fraud in life insurance because it requires death. In other type of insurance, there's a lot of fraud. Let that sink in. Auto insurance is expensive, not because people crash a lot. Auto insurance is expensive because maybe your mechanic charges a lot, or they pad the bill, or maybe there's fraudulent auto accidents. Let that sink in. Health insurance, why is that expensive? Some people are not sick. Some people abuse their health insurance. Some doctors pad up the medical bill. Some doctors bill stuff that was not provided to you, a service. Hospitals do that. Doctors do that. So in health insurance, think about where the fraudulent adds to the cost. Life insurance doesn't have some of those issues. You generally die once. Very rarely do you say, look, 18% of the population had died multiple times. There's a lot of people out there claiming their death, collected the insurance, and they're still living under an alias or something. It is not true. It now, are there corner cases? Absolutely. But I'm sure it's not even 1%. I'm sure that number is so small. It is such an anomaly. But life insurance, in one sense, it's much better than a lot of other insurances. So the cost is truly what the statistics show about longevity of your life. So hopefully by now you understand that this cash value concept is not magically there. It is not a separate investment vehicle. It is not a separate 401k plan account or IRA that's attached to your life insurance policy. That is not a true statement. I think the industry does a poor job in explaining it. I think it gives opportunity for people to nitpick and say insurance companies are stealing it, why you only get one versus the other. This is just so common sense. Don't believe the experts. Just look at the math. You see how many young people don't die as often. Term insurance, while it is designed for one thing, that's exactly what you're buying. And in this episode, we're not going to cover all the other cases where a chronic illness in your family that generally pops up at the age of 40 or 50. If you use term insurance, you better be self-insured then, based on what other people teach. And so this is the beauty of product. You can choose what way you want to use. If you want to use a term insurance, that's okay. Make sure you save money and you can be self-insured. If you're using the whole life insurance, that's fine too. Make sure you get it when you're young and healthy, so it's cheaper. And you don't have to pay to the end of your life. People make it sound like if you miss one payment, you're doomed. That's not true. And a lot of times you can do a single payment or you can pay it off in the first 10 years. It's up to you. There's so many ways to design these policies to make it work for you. With that, please like and subscribe. I'm always here to try to bust other people's myths. I'm here to explain things that maybe you never heard of. I'm going to create a much longer video that explains all this in a much better way and comparing it to term insurance. Once you understand it and the differences, you can decide what's best for you. But today's video was to just address this concept of, is the cash value magically disappearing when you die and that insurance company ripped you off? Is it a separate component? No, cash value is just the amount of your death benefit that you have access to, right, prior to your death. And it's not that hard to understand. Early in your policy, you're only entitled to 0 or 1% of your cash value. As you get older, you get closer to the 100%. There are ways to design the policy so you get access to it earlier, and I covered that. Again, there are many other ways to do it. This video does not cover infinite banking or designing a policy with a small death benefit with a very large paid up addition rider. So this doesn't cover that, and I'm not going to address all of those. But again, stay tuned for future videos. I'm here to help you understand it. I'm here to give you straight answers. I'm not going to beat around the bush. Sometimes there is no one answer solves everything. Personal finance is just that. It's personal. Some cases it works better in your family situation, and for other cases it does not. You have to understand what your situation is, your life, illnesses, whatever it may be, right? Everybody's in a different situation and you can't answer all of those. With that, please like, share, let other people know that I do these type of videos to address some of the misunderstandings in the financial world. Remember, I'm here to help you win with money, not just stock market stuff, not just options trading. I cover things like insurance. I cover things like Bitcoin. It's understanding how things work. Too many people are just an expert in one area. Dave Ramsey is really good at helping people get out of debt, teaching people that, if you can't manage your budget or you can't handle your finances, absolutely stay away from credit cards. Make sure you don't buy things that you can't afford. Dave Ramsey is really good at that. And so he adds a lot of value. Where he doesn't add value is when you mislead the public to believe things that may be just his personal opinion and not necessarily a fact. With that, again, please subscribe. I'm here to help you win with money. Let's do this together. Let's do this $1 at a time. Have a profitable day.